Have you often wondered what are the different tools used in technical analysis? And what is technical analysis anyway? If that is a question that you have, then stay tuned. I have some answers for you. When we talk about technical analysis and different indicators, we first have to talk about some definitions just to make sure we understand what is being talked about. One of the things that we need to look at first is a thing called the trend. What is the trend? Is it going up? Is it going down? Is it going sideways? We also need to talk about momentum. Trend tends to be longer term. Momentum is shorter term. So you may have a longer term uptrend, but if we have one or two down days, the momentum may switch from being positive to negative. So we tend to use these together. Another thing to be aware of is a term called overbought. This is when prices have risen too far too fast. We're looking for a retreat. We also need to know about oversold. This is when prices have fallen too far too fast, and typically we're looking for some kind of a bounce. What is technical analysis? It's a visually based systematic method for attempting to determine future price movement. That's really what we're trying to do here. We use what's happened in the past, we calculate some numbers, come up with some pretty little lines that we look at on a chart, and then we use that to try to determine what is going to happen tomorrow, next week, next month, and into the future. We can use technical analysis to evaluate any tradable security. This can be an index, such as the Dow, the NASDAQ, the S&P 500, a stock, Tesla, Microsoft, Google, Apple, a mutual fund, a bond, or any tradable security. It's not only restricted to the stock market. In fact, the first implementation of technical analysis was really done in the futures market. A lot of participants found that to be successful, and so it found its way into the stock market. Technical analysis, or TA, uses charts for analysis. Instead of crunching a lot of numbers, or coming up with some kind of a hunch, or going on the recommendation of somebody else, technical analysis uses visual charts that we look at to determine what we think will happen. Technical analysis, though, is only one discipline. There are other disciplines that you can use if you use one at all, and believe me, there are a lot of investors that don't really use any kind of discipline when they're getting involved in the market. They just throw money into the market based on what somebody else said and just hope for the best. This is a way of analyzing things and reaching conclusions and then investing using that approach. For many, technical analysis is the main approach that's used, if not the only approach. Technical analysis is typically used to determine when to enter a particular investment and when to exit that investment. So it's a timing mechanism. There are websites out there and services that are available and software that you can use that perform scans. So let's say you have your favorite technical analysis tools that you use. You can program those into a website or into software and then go through the thousands of stocks that are out there. What you see is a return of stocks that meet particular criteria that you like. There's also another approach that you can take, and this is called the consensus approach. This is taught by the SPX Investing Program, and this is the program that I developed and I teach, where I use technical analysis. In fact, I have about a 16-hour class just on technical analysis, but I combine that with other disciplines as well, such as fundamental analysis and mental analysis, and I won't talk about those here. There's other videos that I have that discuss those topics. I have found that when you take TA, FA, and MA together, those can be combined into a powerful strategy that you can use to implement a very successful investment program, if it's done the right way. What are indicators? And that's really the backbone of what we're trying to do in this video. Technical analysis uses this thing called indicators. Indicators are mathematical calculations that are based on price. They can also be based on volume or a combination of the two, price and volume. Historical data is used for the calculations. So we're looking in the past to make our current calculations to help us determine what we think will happen in the future. Indicators can be used to determine current market conditions, so where we're at right now, as well as predicting what we think future prices will do. There's no holy grail when it comes to indicators. Technical analysis has its strengths and weaknesses, and one of those weaknesses is it's not right all of the time. There's no perfect indicator out there. Believe me, people have tried to find that, and they think they find something that's really wonderful, and that may work for a period of time, but if it becomes very popular, it has a tendency to break down. Just about the time you think you have the perfect indicator is about the time it fails you. Investors usually get to the point where they implement favorite indicators. You read a book, you take a class, you do some studying and research yourself. A lot of investors get to the point where they have indicators that they really like, and so they build their own system around those indicators based on their own personality and their objectives of what they're trying to do. Indicators can be very useful and accurate, but nothing is 100% accurate each time. We have different kinds of market environments where things are really trending up or trending down. We get a significant period of time when the markets are chopping and not really going anywhere. Some indicators will serve you really well in trending environments, but they'll give you a lot of false signals in choppy environments, and vice versa. False signals can occur. In fact, they do occur. Every indicator that I've ever used, it may be right a lot of the time, but it's also wrong a significant part of the time. Indicators then fall into two basic categories: moving averages and oscillators. So let's look at the first category of moving averages. The first type of moving average is known as a simple moving average. And if you have a 20-period moving average, what you do is you take the last 20 days, add up all of those prices, and then divide by 20. And that gives you an average price over the last 20 trading days. Then what happens is the next day, on the 21st day, the 21st day is added to that calculation, and the very first day is taken off of the calculation. This is repeated day after day after day, and what you see on a chart ends up being a line. And that can give us a lot of useful information. There's also a thing called an exponential moving average. Some people think day number 1 should not be as important as day number 19 in the calculation. You want prices to be closer to now. Well, they take a moving average and they weight it a little bit different. So prices that are closer to the current price are given more weight in the calculation than prices that happened 19 or 20 days ago. You can see where that would make logical sense. But there's a debate that goes back and forth. If you take a moving average of a moving average, and there are some indicators that do that, you find yourself getting too far away from actual calculations that can really lead to intermittent success. The exponential moving average is already set up with a certain weight that's given to it. There are other moving averages where you can go in and change that yourself and modify it as you see fit. There's also a moving average system and a whole book on this called Bollinger Bands. They were developed by a gentleman named John Bollinger, and I've read the book, and it's a good book. Some people find this to be a very effective approach to analyzing current prices and where we think they will go. Other people just use it as part of their overall package of tools for analysis. There's also another indicator called the MACD, and yes, that is an acronym. It means Moving Average Convergence Divergence. It was developed a long time ago, has become very popular. I look at it every day, and a lot of investors use this as their favorite indicator. It may not be your favorite indicator. You may come up with something different, but this is very popular. Both of these types of indicators, the Bollinger Bands and the MACD, they are based on moving averages. Usually what we do with moving averages is we plot those on top of prices. So you see a price chart, and then smack right on top of that chart is a moving average of some sort. This helps to smooth out price movement. When you get markets gyrating all over the place, it can be really hard to make a decision. Some people just use charts with no indicators at all, but we can get into environments where prices are not really making a lot of sense, and so a moving average will take an average price, and they tend to be a lot easier to interpret and a lot simpler to manage. Longer moving averages are slower than shorter moving averages. And if you think about it, it makes sense. If you have a 10-period moving average, that's going to go a lot faster than a 200-period moving average. Systems have been developed where you use a crossover in order to get in or to get out of the market. I have another video called the SPX approach, where you use a 50-period moving average and a 200-period moving average, and those generate buy and sell signals. So please feel free to watch that video if you find that interesting. Moving averages are a lagging indicator. It can take some time for these things to move. It's like the Titanic heading towards the iceberg. They're trying to turn it, it's trying to go around the iceberg, but they just don't quite make it, and they end up hitting the side of the iceberg, at least according to the movie. Some different analysis that we can use with moving averages includes the direction. Is the moving average line going up or down or sideways? Where is the moving average in relation to the price? If we see price above a moving average, that is positive. If we see price below a moving average, that is considered negative. A moving average can act as a magnet. You'll notice on some of these charts that prices don't get too far away from any particular moving average. They'll get a little bit out of line and then they'll come back closer to the moving average. And that's a large part of what Bollinger Bands are based on, is trying to take advantage of quick movement. And when the bands get really wide, that means there's a lot of movement going on. And when the bands are really small, that's when there's not a lot of movement right now in the market. Moving averages can also act as support. So if prices are above the moving average and they start to fall, they may come down to a moving average, use that as support, and then bounce up off of that. They can also act as resistance. If prices are below a moving average and they start to go upward, they may come right up to that moving average, stop, and turn around and go back down. Not always. This is something that we watch and keep an eye on, and it can be insightful as to what will happen. So what are some popular moving averages? There is a big debate over whether simple moving averages, where every time period that's used in that calculation is given the same amount of weight. There are other people that think, no, the calculation needs to be performed a little bit differently. And you can make a case for either side. A number of years ago, I was reading a book. It's considered the Bible of technical analysis. It was written by John Murphy. It's called Technical Analysis of the Financial Markets. He did a study in that book where he compared simple moving averages to exponential moving averages, and his ultimate conclusion was simple moving averages are better. Why? Because they're slower. The nice thing about a moving average is that it avoids the noise that's going on. So you don't have to pay attention to shorter term gyrations. A lot of times, especially when you're in an investment, you may be more inclined to pull the trigger and get out, where staying in would have been better. Exponential moving averages move faster, so they react a little bit quicker, and sometimes they make you get out a little sooner, where that might not have been the best thing to do. Now, just about the time you implement that as part of your philosophy, you're going to use a simple moving average and it's going to betray you. Yes, there's some research to back up that simple moving averages are better. In reality, both can be right and both can be wrong. Any time frame can be used. You can go back and use a 3-day moving average or a 9-day moving average or a 400-day moving average. Whatever you want to use will work. There seems to be no magic. Some people like to base them on Fibonacci numbers. Other people like to use more round numbers. The most popular moving averages out there are the 50-period moving average and the 200-day moving average. That gives us a longer term view compared with a more intermediate term view. If you have a moving average that's 10 or less, that's usually short term. You can go all the way up to 20 with this number. I use all different kinds of moving averages. There's really no magical number. If you use a 50 period, that's more intermediate term, and then a 200 period is more long term. If you use a bar chart for your analysis or a candlestick chart, you'll notice that there are 4 prices for any given day. There's the open, the high, the low, and the close, and we can base a moving average calculation on any one of those. So you can base it on the open, the high, the low, and the close. Just to give you an example, one system that I developed years ago uses the daily spread between the high and the low to determine how much volatility there is at any given time. I take the high minus the low, that gives me a number, and then I plot that as a moving average over time. Most moving averages that you use are going to be based on the close. That's what mutual funds do. That's what most people look at. That's the price that's quoted on the financial channels or in publications that you may refer to. Let's look at the other category of indicators, and these are called oscillators. Very simply put, to understand what an oscillator is, just think of it like a fan. It's a hot summer day, so you go over and you turn on your fan. You can have that blowing right at you, or you flip this little switch in the back and the fan goes so far in one direction, stops, and then comes all the way back in another direction, stops, and just goes back and forth and back and forth. That is an oscillator. They measure momentum as well as the trend. Momentum is shorter term, where trend is longer term. They're constructed to move in a range, like an oscillating fan. For example, a lot of oscillators have 0 as their bottom and 100 as their top, and that indicator will always stay within that range. What we're looking for when we use oscillators are extreme values. When the oscillator is showing a real high reading, let's say 80 or above, or 90 or above, or 60 or above, that enters in what's called the upward band, and sometimes that makes us take notice and do things. This may mean that something is overbought. That's the other definition that we looked at. When prices are moving up really fast, they may go too far too fast and become overbought. And when that happens, we're looking at some point for prices to turn and go back down. Please be aware that we can be in overbought or oversold conditions, what I'm going to talk about next, for extended periods of time. How a trigger is officially signaled is when it goes up into that upper band area and then comes back down and drops below the upper band. That's when the signal is generated. You might hear on the videos that I do where I'm constantly saying we're in overbought territory or we're in oversold territory. It doesn't mean that we're overbought or oversold in the sense that a trigger has been initiated. It just means we're in that territory. Our oscillators are showing some kind of an extreme reading, and we need to keep an eye on that. Then we have the lower band when prices are really falling, but they may fall too far too fast and become oversold. Typically, oscillators are more sensitive to short-term price movement. If you become a member of the program that I offer, I do daily videos and I do weekly videos, and you will constantly hear me talk about momentum and trend. We might be in a longer-term trend that's going up or down, but the short-term momentum may be in opposition to that. What are some different oscillators out there that are popular? Some of these you might have heard of. You're going to get the phone book when you come up with oscillators. Everybody seems to have their own latest and greatest oscillator that's out there. People usually ask me, what's my favorite? All of them. I chart as many as I can because I have a whole different approach than what other people use when it comes to implementing technical analysis. But some popular ones that you may run across may be a thing called stochastic oscillator. And that's kind of a scary word. It can be a little hard to say at first. There's also a thing called the relative strength index. This is one of the first oscillators that people will usually learn when they're taking some kind of a technical analysis class. It's the first oscillator I teach, and all the books that I read, it's the first indicator that you come across. In fact, later on, I'm going to show you an example. The RSI is one of the indicators that will be plotted. There's also a thing called the rate of change. How have prices changed over the last 5 days, 10 days, 50 days? There's also another one called the money flow index. I just call it the MFI. And I look at all of these every day. I don't have a favorite. There's some that I like better than others. For the most part, I'm looking at all of these. Where can you get some information if you want to learn more about moving averages and put them to use in your program, or if you want to use oscillators, or if you want to use a combination of the two together? A really good site is stockcharts.com, and I'm just going to go there in a moment. If you are not a member right now and you want to sign up for one of their membership programs, please use this email address, spxinvesting@gmail.com. That gives me a little bit of a benefit because I am a member of this site. I don't own any of this. I'm not a teacher for them. I go to their webinars. I find them to be pretty useful, and I'll go to their website here in a moment and just show you a little bit about them. There's a lot of good tools that you can get just for free. But if you decide you want to become a member, please use this email address. And for every month that you sign up, after you've been a member for 2 months, I get a free month. That helps to keep my costs down so I can do these free videos and I can keep prices lower in the membership program that I have. There's another tool called Metastock. That was the piece of software that I used to learn technical analysis a long time ago. It was back in the old DOS days. It wasn't even a Windows program at that time. It's a monster program, and it will do pretty much anything you want it to do as far as technical analysis. It can be a little expensive, especially if you get the intraday real-time package. I don't use it anymore because it's so hungry for resources. It's hard for me to run multiple programs at the same time and maintain stability. But it's a great program, and it was a great learning tool, and I'll always be grateful that I was able to use it. There's another piece of software that's also a monster. It's called Think or Swim. This is available by setting up an account with TD Ameritrade. You're allowed to download this software and use it, and it is a monster of a program. I have extra classes that I teach just on how to use Think or Swim. We call it TOS, Think or Swim. It was developed by some other people, and they ended up selling this software to TD Ameritrade, but it's still a very effective and very powerful program. There's a new one that was created by the makers of Think or Swim that's called Tastyworks. It implements a different approach, but it's really good if you trade a lot of options. And if you do a lot of spreads, whether they're debit or credit spreads, you may not know what that means. Don't worry about it unless you take my classes. That can be really good, and that's freely available too if you set up an account with Tastyworks. Most brokerage accounts have access to technical analysis tools. If you have an E-Trade account, Scottrade account, or a Charles Schwab account, or any kind of an account that's immediately coming to mind, you probably have some kind of technical analysis tools that you can use, and they're part of your account. Let's look at some of the tools that we have available and get some examples. What you see in front of you is stockcharts.com, one of the sites that I recommend. You can see up in the right-hand corner, I'm not logged in right now. So this is what you see if you just go and visit this website. There's a lot of free tools that you can implement. What you can do at the very top is enter a symbol. Since I teach just about the S&P 500, that's what I'm going to do. And so I enter $ and then SPX. And you can see it comes up with the S&P 500 large cap index. And you're going to see a template that they use with indicators already built in. So I click on this, and boom, we already have a chart. Now you can't do an awful lot with this unless you're a member. About the only thing you can do is come down to the bottom, and you can see they already have an RSI and a MACD plotted. You can change this to make it a little bit bigger, and that's really about all you can do. But this will give you some insight as to what I'm talking about. Here we have what are called candlesticks. And some people really like candlestick charts. If we see a red candlestick, that means down. If we see an open candlestick, that means up. On my charts, I use green, but here they just use open. Also, plotted right on top of the price chart, you have two moving averages. The blue line is a 50-period moving average, and the red line that you can't really see all that well is a 200-day moving average. This gives us a lot of information just by itself. Where is price? And we're looking right here at the very edge. That is the latest price. That is known as trading the right edge. That's ultimately what we want to focus on. We can look at all the crazy stuff back here to get some insight, but it's going to come down to What do you think is going to happen after the most current price? We can look at this and see that the last price was above the 50-period moving average. The 50-period moving average is above the 200-day moving average. That's positive. And price is above both of them. Ooh-hoo-hoo. So this is a pretty positive picture. We can get a lot of insight from that. The other histogram that's along the bottom is volume. And there are whole volume studies that I go through in the classes that I teach that helps us to understand when volume is important and when we don't really need to pay attention to it that much. What you also see at the top of this chart is an oscillator. This is the RSI. It trades back and forth in a range anywhere from 0 to 100. How they have it set up on this chart, once we get above 70, that is in overbought territory, but the signal isn't actually generated until we drop back down below that. That's when the overbought signal happens. Most of the time, this oscillator just kind of oscillates or goes back and forth in this range. At the time I'm preparing this video, the markets, ever since before the 2020 election, have really been going mostly sideways. Yes, we've had some upward bias, but there hasn't been a lot of conviction. You see a lot of money being thrown into the markets these days to stimulate the economy. They're not really the big players that can influence prices to go up or down. It's really the Fed throwing things into the market. So this oscillator has pretty much gone sideways. If it was to drop down below 30, that's when we are in oversold territory, but it doesn't really trigger a signal until it comes back up and crosses above the 30 line again. If we look down below, this is the MACD. This helps to determine trend if these lines are going up, and it also helps to determine momentum. And we can see, is the dark black line above the red line? That means the momentum and the trend are up. When the dark line drops below the red line, that means the momentum or trend, at least on a short-term basis, has shifted to down. And then you see a histogram that's plotted here as well. This just measures where we're at in relation to this black and red line with each other. Some people focus on the distance between these lines. Other people focus on what is the MACD line actually doing. Other people use a combination of the two. And we can see over here way on the right-hand side, how do things look as of right now? Just using this chart, things look pretty positive right now, but trendless. The RSI is not really registering any kind of an extreme reading. The moving average is going up, both the 50 and the 200, and price is above both of them. Then we look down at the bottom, the MACD has the black line over the red line. So all of three of these things together line up, and it concludes that we are in a pretty positive environment right now. The one thing that is concerning is we're seeing the RSI move sideways a lot. It's not showing any real extreme readings. So that may make us a little bit apprehensive to get into a trend type of instrument right now. If you're interested in looking at Metastock, and it's not that I don't like the program anymore, I've just decided to use more of a web-based approach, and I use different software. Just go to metastock.com. You can look through the different products that they have. You can create an account and look around and just see if this is something that you want to use. I have no connection with them now. If I was using their software these days, I would probably sign up with them. I've actually talked to them in the past where if you buy their product, I get some kind of a fee for that. I don't use their product, so I don't really feel good about making money off of them. Another account that I have is with TD Ameritrade. This is where you can go and get the Think or Swim software. If that's of interest to you, just go to tdameritrade.com and that will bring you to their homepage. If you scroll down and you go to Tools, this is where you have access to Think or Swim. They have a desktop version and a web version. I found the desktop version to be more for what I need. Another website that you can go to is tastyworks.com. This is where they have the Tastyworks platform. And these guys are real rock stars as far as technical analysis, and now they've set up a brokerage firm that you can use. They offer a lot of education. Some of you may watch some of their videos or tune into their channel. They're pretty good guys. I've learned a lot from them over the years. If you want to use their platform and use some of their products, I would highly recommend that. I would like to thank you for taking the time to watch this video. If desired, please click a like or even a dislike in this video in the button below. That will really help me out. If you have any comments about what I said in this video, please leave them below. If you have questions, I'll try to answer them the best that I can. Or if you like or dislike the video and you want to just give some kind of feedback, that is always welcome also. Consider subscribing to this channel and clicking on the little dingy bell down at the bottom so that you'll be notified when new videos are posted. I try to post quite often, and as the channel gains in popularity, there'll be more and more videos available for you to watch. So thank you again, and I will see you in the next video.